Is the housing market going to crash? I think that's the question on everyone's mind right now. My name is Jose Munoz. I'm a real estate agent since 2018 and a mortgage advisor since 2006. I'm going to answer that question along with give you an update on economic data, the real estate market, and mortgage rates. So stay tuned. Let's get started. So as many of you know and are well aware of, we're in the midst of an economic slowdown. Whether we're in a recession, some are saying we are, some are saying we aren't. I tend to believe that we are currently in one or we're going into one, and I'll give you the data as to why I believe so. This is a chart of one of the leading indicators of an upcoming recession. It's the 10-year and 2-year treasury yields and the inversions throughout history. Whenever the yield curve does go inverted, that's the 10-year yield is below the 2-year yield. So you can see in the past, every time the yield curve goes inverted, it's in red. A recession is to follow, which is the shaded in gray areas. So every time it's inverted, a recession has followed. Even in 2020, there was a very short recession at the beginning of the year, and there was an inversion in 2019. This year, we first inverted back in March. This is actually an older chart here, and we have had more inversions, and we are currently inverted, and that's going to deepen with the latest Fed rate hike. The unemployment rate in recession, so you see people, including our president and other politicians, those speaking from the White House, have said that we are not in a recession. How can we be in a recession? Because then the unemployment rate is so low. If you look back at history, recessions always come at times of the lowest unemployment. So you see every single time here, again, recessions are shaded in blue, that unemployment has reached peak lows. A recession is to follow. So at this point, employment levels, the hiring has seemed to have staggered a little bit and slowed, and we could possibly see unemployment start to tick up in the coming months. We'll keep an eye on next week's jobs report just to see how that number comes out. That'll give us kind of an idea. We have flatlined at 3.6%. I believe that last 2 months have been at that level. So let's see if that starts to tick up, and that's another indication that we could be in a recession. Now, we're not officially in a recession until it's called, but that might not actually happen for another few months, possibly even the beginning of next year when it's official. But we have had 2 consecutive quarters of negative GDP. By definition, that is a recession. There has never been in the history of our economy 2 negative quarters of consecutive GDP that was not called a recession. So let's see what happens. How will that affect us? How will that affect housing? Historically speaking, housing has done well during times of recession. So in 8 of the last 9 recessions, housing has actually appreciated or stayed level. You can see that chart here. Again, the recessions are in the blue shaded areas. The only time there was not appreciation in the housing market was during the Great Recession of 2008. That's because the recession was caused by housing and fraud in the housing market. So we saw a steep decline in housing prices at that time. This time, of course, I mean, it's a very different scenario then. Supply levels were very high. We'll get into that in a minute. That's not the case today. Mortgage rates during times of recession. So historically speaking, over the last 6 recessions, mortgage rates have declined during the period of recession. So they peak at some point during the recession. Again, they're actually highlighted in yellow, and they reach their lowest levels before the end of the recession. So we can expect, if we are in a recession, mortgage rates will come down. This is over the last 6 recessions. Mortgage rates have all come down on average 1.8% during the time of the recession. Where are mortgage rates today? They're high. They've gone up. They've almost doubled since the beginning of the year. This kind of gives you an idea of how low we were and where we are currently. Actually, probably a little bit lower than this here. Again, this is an older chart. So where are mortgage rates going? That's the question on everyone's mind. Most experts are saying that mortgage rates are going to come back down towards the 5% range by the end of the year, possibly even lower into next year. I think if, again, once it is called that we are in a recession, and once inflation gets under control, then we'll start to see mortgage rates come down even more. But how could that be? Many say, you know, the Fed, the rates keep going up, the Fed keeps increasing the rate. That's something that I want to address here. It's a common misconception that the Federal Reserve controls mortgage rates. That can't be further than the truth. The Fed does not control mortgage rates. They do not control long-term lending rates. They control short-term lending rates. So when the Fed increases their rate, that you hear on the news that they just increased 75 basis points this week, that does not mean that mortgage rates go up 75 basis points. Actually, it's quite the opposite in many cases, and I'll show you that in a minute. And you can see that actually in this chart. When the Fed hikes, mortgage rates will actually go down. This is a long-term chart of the 10-year Treasury yield, which mortgage rates are directly tied to. And you can see in past history, I believe this goes back 6 years, mortgage rates will actually go down after they hike in most cases. Of course, there are other factors that come into play, but you could see that when the Fed hikes rates, it does not cause mortgage rates to go up. What the Fed is doing by hiking rates is they're trying to slow down spending, calm inflation. Inflation is really the enemy of the mortgage bond. So when inflation is high, mortgage rates will go up. When inflation comes down, mortgage rates should follow. So here's a more accurate depiction so I could show you exactly what's happened when the Fed has raised rates and what's happened over the past couple of months with mortgage rates. So let's go back to January. You could see here, this is when mortgage rates were at their very lowest. Again, this is a chart of the 10-year Treasury yield. Each one of these little bars represents 1 day of trading. Green bars represent a positive number. That means mortgage rates went up, and red means they went down. So here you can see we were at our lowest point here back in December, and mortgage rates started going up in January. At the very beginning of the year, mortgage rates started going up. So it had nothing to do with the Fed raising their rate. The first rate increase was actually right here, March 15th. And you can see the increase that took place at that time was not perceived by the market as being enough to slow inflation. So we saw rates continue on their upward trajectory. On May 5th was the second rate hike of 50 basis points. The market took that a little bit better. They saw it as being anti-inflationary. So we saw mortgage rates start to come down during May. But then we got a lot of data out of how bad inflation was, and we saw rates start to go up dramatically to their peak on June 14th. June 15th was the big rate hike of 75 basis points. At that time, we saw one of the steepest declines in mortgage rates that we've seen in some time. So we saw mortgage rates drop down. And then here was the latest rate hike of 75 basis points. This was expected, so we didn't see as big of a drop, or at least we haven't yet. But we were expecting 75 basis points, but we did see a drop down into some levels that we haven't seen since April and May. So you could see, again, every time the Fed hiked their lending rate, mortgage rates went down. It's not what you hear in the media. It's not what you hear on every news outlet. The media plays off people's fears. We're not going to get into that too much right now. Just know that what you're hearing sometimes on the media isn't completely accurate about mortgage rates. You don't want to miss out on an opportunity if you're sitting there on, and not entering back into the housing market because you think that rates just went up by another 0.75%. No, it's actually quite the opposite. Rates have gotten much better. So maybe it's time to start looking again and see where your mortgage payment would be today. Okay, the real estate market inventory update. Let's get into it. So we have seen a buildup of inventory over the past few months. It's not completely abnormal that we see a buildup of inventory around this time of year. It is, after all, the spring home buying season, and we do see these peaks and valleys every year. with lower inventory during the winter months, higher inventory during the summer months. That's the spring home buying season, and that is what we're in right now. Maybe a little bit more of an exacerbated move upwards due to the fact that we were at record low inventory levels, so a lot more houses did come to market than normally would, but you can see the spike is not completely uncommon, and we still are at very low levels of inventory. We're only at just over 2.5 months of inventory on the market nationwide, when we should be closer to 6 months of inventory on the market. So inventory levels are still very low. It does not completely indicate a healthy market, healthy balanced market just yet. Home sales through the year have come back down. They are much lower. There's without a doubt a slowing in the housing market compared to last year's gangbuster year. That's not something that we should expect going forward. That it wouldn't be healthy if that continued to happen going forward. So we're starting to see more normal levels of sales. There's not 20 offers on every house that comes on the market. Houses are taking a little bit longer to sell, as they should. So should you buy a home right now? Many people base that decision off of how their investment will perform if they do purchase a home right now. Will the market go down? Will you lose value in your home a year from now? Well, many experts seem to think that that's not going to be the case. They do believe that we're going to see about 8 to 9% appreciation this year. And in the coming years, we're going to see more normalized levels of appreciation between 3 and 4%. Which is good. That's a healthy market. That's more standard. That's where things should be. You don't see negative numbers there. You don't see any red. You do see all positive. So if you were to buy a home this year, indications, what experts are saying is that we will see some kind of positive appreciation over the coming years. So you should not lose value in the asset that you buy. One of the main reasons being, and the main driver of the real estate in all markets really, is supply and demand. So whenever supply is low and demand is high, that's supportive of values. Here we see a chart of new home construction, new home builds over the past decade, which has been very low. Some of the lowest levels of around 2010, and they did start to build. Now there has been recent reports that home builders are losing confidence and they're slowing down their building, so that means less supply that will be coming to market over the coming years, which again is supportive of value, and that along with the supply of resale homes, which is lower than where it should be, is going to keep these supply levels low for the immediate future. So where should demand be over the coming years? So we're entering the peak home buying years of the millennial generation, which is the most populous generation. So we can expect that demand will stay elevated or at least stable in the coming years. That should not stagnate too much. Experts don't believe the market is in a bubble or a crash is in the cards like during the Great Recession. The nation is still suffering from a housing shortage that has reached crisis proportions at the time when many millennials are reaching the age when they start to consider home ownership. That's likely to keep prices high. So what's my take on all this? Is the housing market going to crash? Back to my initial question, I don't believe so. I believe the housing market is going to stay stable. I believe that mortgage rates will probably start to come back down, and that's going to be more supportive of demand and supportive of prices, with the level of supply still being low. Should you buy a house right now? That's really a personal choice. I just want to present this information and this data to you so you're not too reliant on media sources and what's out there, so you can see the raw data and what's actually what plays into the housing market and mortgage rates, and let you make your own decision. What I do know is that there is less demand out there right now. There's more supply than there has been over the past year and a half. So the competition, especially if you're a first-time home buyer or a home buyer that's had a hard time getting a house because competition levels were so elevated over the past 2 years, competition is lower now, so it might be easier to find that home that you're looking for. My name again is Jose Munoz. I'm a real estate agent here in Miami, Florida with Keller Williams, and a mortgage advisor with Get a Rate Home Loans in Florida and in New Jersey. So if you have any questions, please feel free to reach out to me. Stay tuned to this channel for more future updates coming very soon. Thanks so much for watching. You guys have a great day.